Hello, good morning, good afternoon, good evening, everyone, depending on wherever you're dialing in from. Welcome to our newest webinar from the Policy Center for the New South. Today, we're going to be discussing with our experts what happened recently to SVB and Crédit Suisse. How, is this reflecting on the global financial system? How healthy is the global banking and financial system? And how can policymakers react and contribute to their stability future? So I'll go ahead and get started by introducing our panelists. So first, we have Mr. Hin Din. Hin is a senior fellow at the Policy Center for the New South. He's also a president and CEO of Economic Growth and Transformation, LLC in the United States. And he's a senior research fellow at Indiana University. Hin spent over 35 years working at the World Bank Group. We also have with us Ms. Henriette Guémin, who is a senior fellow as well at the Policy Center for the New South. She is also director of the Commodity Finance Center at Birkbeck, University of London, and a professor at the Johns Hopkins University, who focuses on probability, commodities, and finance. She was chairman of the finance department at ESSEC Business School from 1988 to 1995 and director of Dauphine Master 203 at the University of Paris Dauphine from 1995 to 2005. My name is Fatima Houedi. I am an alumni of the Atlantic Dialogue's Emerging Leaders Program, and I'm very happy to be moderating this discussion. So we'll go ahead and get started. Hin, let's start with you. So can you please tell us, how did this banking crisis in the US happen?
Well, the root causes of the current banking crisis had to do, I think, with the long period of low interest rates, which the Fed has held since the great financial crisis of 2008 to 2009. Between 2009 and 2020, interest rate was kept mostly at zero level. So a lot of expectation in the public and among the banks are that these rates will continue to be kept low. So when the signs of inflation, of inflationary pressure began to emerge in 2020 and 2021 following the pandemic, the Fed began to raise interest rate. But then, in my view, it did it a little late. And for the whole year of 2021, it didn't do anything. Then in 2022, it started raising the interest rate, specifically the federal funds rate. Now, what happened is that during the period before that, because of the low interest rate environment, a lot of the banks had tried to maximize their profit by investing in long-term securities to get a higher rate of return on their money. In meanwhile, because of the Fed policy of easy, what they call quantitative easing, there was a lot of money flowing around, and the deposits expanded very rapidly. So some of these banks, in particular, the Silicon Valley Bank, had very rapid growth of deposit within a short period of time. And meanwhile, they have invested most of these deposits into longer term bonds. So when the interest rate rises, in principle, every time you have an interest rate increase, the net margin of the bank improve, and so the bank should benefit from it. But in this case, instead of benefiting from the interest rate increase, the Silicon Valley Bank will then get implicit losses in their balance sheet. And when the depositors started to withdraw money, they had to pay for these deposits by selling these bonds, and in the process, making the unrealized loss become realized loss. So in the banking sector, confidence and trust is the key. So if the depositors have a problem of confidence on the bank, in particular in this case, the Silicon Valley Bank, then the bank run is bound to happen, and that's what happened. And that problem, the problems that Silicon Valley Bank has with other banks right now in trouble is that, number one, they did not have a good risk management scheme or risk management step. In the case of Silicon Valley Bank, for the whole entire year, there is no, for the year of 2022, there was no chief risk investment officer of the bank. And then most of the staff of the risk management department was actually commuting to work, meaning they just stay home and do work on the computer. And so risk management is a problem here with the bank. And number two problem is that there's been negligence from on the part of the supervisors, of the Fed supervisors. They should have found out about these problems earlier. And then once they found out, they should have taken a lot more decisive actions to stop it. And the third problem is, of course, the regulatory framework, meaning that Frank revised act in 2019, I believe, which exclude the banks with assets less than 250 billion from the stress tests that are usually conducted for large banks. So in this case, the Silicon Valley Bank was excluded, and they didn't have to pay attention to the stress test. And of course, the final factor to be, and one of the most important one, is the Fed decision to raise interest rates so fast and so high within a short period of time. So between March 2022 and now, in May 2023, in a period of 14 months, the Fed had raised the federal funds rate 10 times and by 5 percentage points, which is the highest level in 16 years. So that's my take on the problem.
Thank you very much. And Heliette, let's hear from you. What's your take on the situation, and how is this affecting overall US economy and financial stability?
Okay, thank you. So firstly, I will say that I greatly agree with what was said by my colleague and co-speaker, namely that interest rates were kept too low for too long. Among my former PhD students, one of them is even more famous than the others. His name is Nassim Taleb, and in general, is very aware of regulators stepping in when it's not necessary. And we got a crisis in 2008. So at that moment, certainly the intervention of regulators was deserved. But after that, as of the years 2010, 2011, and so forth, the fact of keeping interest rates very low was just wrong. It was creating a lot of money, as was said, and this inflated in particular the deposits that were sitting on the liability side of the Silicon Valley Bank. And by the way, another bank got problems, as you know, First Republic, which has been absorbed with the help of the US government by JP Morgan over the last few days. So in general, there are two principles, at least, that we could identify, namely that regulators should keep their power of intervention only for the real crisis. If they use it when it's unnecessary, the result is absolutely counterproductive. Secondly, we should not have interest rates close to zero for too long, in particular for a simple reason, namely that if there is any kind of crisis or problem, we can go nowhere acting on interest rates because they are already at zero. So it's like we are using some kind of protection, hedge, whatever you want to call it. So that's exactly what happened. And as was said, the Fed suddenly started raising interest rates too fast. And when SVB collapsed, we had got 2 days before not only a change in interest rates, but the announcement that there would be more. And suddenly everybody was getting their money. And as we know, and it has been said many times, today people are very connected. Friends can warn each other. So the minute we have somebody who has decided that the bank would collapse, this somebody is going to call, text a large number of friends, and this will create the bank run we saw. I want to say that since I have the pleasure to continue to be an academic both at Johns Hopkins University and at the University of London, I want to say that remarkably, in terms of time, the last group of Nobel Prize winners in 2022 was called Ben Bernanke, whose name is familiar, and two academics by the name of Diamond and Dybvig. And among the founding papers written by the last two authors, one is precisely about bank runs. And in a kind of simple setting, they show that in a Nash equilibrium setting, we have two equilibrium states, one where the bank functions as usual and everything is fine, and one in which a single investor is going to become convinced that there will be a bank run, and this single agent is going to warn the others to withdraw their funds, and this is exactly how this bank run is going to be created as a so-called self-fulfilling prophecy. So, meaning that as of today and as of last year or whatever, banks should be aware that the profile of their customers has changed. In particular, the depositors, they don't necessarily behave in the same way as their parents. So consequently, analyzing the profile of your depositors does matter. Secondly, the old rules that we learned 20, 25 years ago in so-called asset liability management absolutely should continue to prevail, namely that if you are consuming the deposits of your clients to buy long-term securities in order precisely to benefit from higher interest rates, you create a so-called duration gap between your deposits, which have a very small duration. They may go from one day to the other, and the asset side of your balance sheet, which is going to be much longer. And we know that this difference is a key number, even in simple models of interest rates where the yield curve moves in a parallel manner. This first measure, called duration risk, absolutely needs to be taken into account. And so, as we know, in the management of a bank, we should have financial criteria, risk criteria, and obviously knowing the profiles of your customers. And you certainly do not want to have a single type of customers. And the US is my second country and the country where I spend a lot of time, including at work. And we do need these regional banks. The US is a very vast country, and these regional banks have the merit of providing funding, loans, mortgages, loans to small corporations. So their survival is absolutely crucial to the US economy, and consequently, their monitoring needs to be better performed by the regulator from outside and by the internal risk managers inside. And it was mentioned that indeed for 6 months during the year 2022, SVB did not have a chief risk officer. So consequently, the absence of a chief risk officer, when at the same time, the assets of the bank went from 71 to 211, which is a multiplier of nearly 3. And consequently, it was crucial to see how this increase happened on two sides of the balance sheet. So we learned lessons, and it would be necessary to make sure that these lessons are integrated again by the managers of the small banks which need to exist and the regulators. And as a final element, I will mention that regarding First Republic, it was and very much so upon the strong request of the US government, acquired over the last 3 days by JP Morgan. But JP Morgan is a gigantic bank at this moment in time, so absolutely deserves the quality of too big to fail. So it is going to mean that there is no way out. Either a bank is too big to fail, or it is small and it is going to fail or be absorbed. And we see that at this moment in time, and not only because it was observed by the Senator Elizabeth Warren, but from a scientific perspective, we see that there are many actions that the US government and the Fed and the Treasury need to take in a concerted manner in order not to repeat what has happened now in the last 2 months, and preserve the network of regional banks, which continue to be extremely useful in the US. And we understand that if we went to other countries, in particular emerging countries, the same property will prevail. Namely, in emerging countries, we have banks which are bigger than others, but we know that we want both types to be survived because the smaller banks are close to their customers in terms of providing funding for their companies, for the startups, and so forth. So basically, we have two concerns: make sure that the regulators pay attention to the global picture, and try to support the medium to small size banks, including with the help of the government. I will stop here.
Thank you very much, Heliette. Just a follow-up question to you both before we move on to the subject of the crisis impacting emerging and developing economies. On the subject of the risk of having mega banks, especially in this era of consolidation, perhaps turning over to what's happening in Switzerland with the merger of Crédit Suisse and UBS. What are the risks that you see there in having a bank that's twice the size of the GDP of its country? Heliette, perhaps we'll go back to you and then we'll go to you.
Sure. Okay, so thank you very much. First, just a small point, with all respect for Switzerland, where I have so many friends in all types of activities, including in the financial sector, and in all due respect to Crédit Suisse, I will observe first that unfortunately, Crédit Suisse in the last few years has been involved with a series of financial disasters, like investing a gigantic amount of money with a so-called customer called Archegos, which was a hedge fund, and where they lost more than $1 billion. Crédit Suisse was involved with some bank issuance in a developing country, and something wrong, including from the ethical standpoint, happened. And this implied a loss for Crédit Suisse. There were some internal fights within the bank, which should never happen in a bank of such quality, notoriety in a country called Switzerland. So firstly, I would say that SVB and Crédit Suisse have essentially nothing to do with each other. One collapsed much faster, it is SVB, and Crédit Suisse, unfortunately, had a long series of bad decisions which were made by the top management. And indeed, Fatima, you observed that the proper decision of the Swiss government to absolutely help and convince UBS that it was not only a matter of helping Crédit Suisse, but a kind of helping the country as a whole, since, as we know, for a long time, Switzerland has been highly respected for its financial sector. So basically, we should try to recognize the situations where nothing was made better for too long a time period, and a situation of a bank which is much smaller, SVB, where the risk management was not properly represented at a time of gigantic expansion of the bank. Multiplying by 3 the balance sheet is, by any account, a gigantic move. So maybe bringing these two types of banks together in our analysis allows one to see different aspects of wrongdoings in the financial world at this moment in time. So I pass the floor to my friend In.
Thank you, Heliette. I agree completely with Heliette that the causes of the SVB and of Crédit Suisse are different. The Crédit Suisse has been burdened by the whole series of scandals, financial scandals, including the scandal, as Heliette mentioned, but also the scandal that the previous managing director or the president or whoever is called the chairman has had. But is what happened there and what happened here in the US is there tend to be a higher concentration of large banks versus the small regional banks that Elliot mentioned earlier. And there, I think the point is that you would need both types of banks. You need the regional banks because it is the regional banks, as Elliot stated. It is the regional banks that provide the banking services to the communities, especially in the rural areas. And so the small regional banks play a very, very important role in providing banking service to the public. At the same time, the large banks are too big to fail could serve as a center to mobilize domestic savings in a more efficient way, and in the process channel actually play the role of intermediary, meaning mobilizing saving and channeling it to investment in a more effective way because they have a broader scope. So to go back to the key question that you mentioned earlier regarding the stability of the financial sector in the US. Your question is actually $1 million question because these things are still unfolding. And in the banking sector, the key thing is the confidence or the trust. So no matter how you put it, if depositors do not have confidence in the banking system or in any bank, then that bank is likely to run into to have a bank run. So the key part right now is how to restore the confidence, by the public to the banking system. And I think that's the reason why the Fed had decided to go on the way in terms of guaranteeing not just the maximum of $250,000 that the FDIC is allowed to insure, but also to make good on all the deposit of SVB. And I think they did the right thing. But a lot of what will happen or what will determine the stability of the system will ultimately depends on how the public view the banking. And if I have to say that by and large, I believe in the overall health of the banking system of the financial sector in the US, because what happened is after the 2008, 2009 financial crisis, the banks actually, especially the large banks, was strengthened in terms of the capital. And so, but the problem is it's mainly for the large banks. So for the small banks, there's a lot of issues with the supervision, with the regulatory framework, and that's where the problem is most likely to happen, the small regional banks. And that's, I guess, that will continue to happen, bank runs for the small regional banks. And as Elliot pointed out, this does have an impact on the economic activities of the rural, of the smaller communities, not only because these banks will stop lending, but also because in the upcoming days, one would expect that the regulatory authorities will come up with more tightening of the rule and regulations, and therefore will cut the lendings even more. So one of the inevitable effects of this current banking crisis is that there will be a tightening of the money supply in the days ahead, independent of of what's going on with the interest rate.
Mm-hmm. Great, and then perhaps if we switch over the page to what are the ripple effects to emerging and developing economies? I understand you've spent a lot of your career focusing on sub-Saharan Africa. Are there any ripple effects? Could a similar crisis potentially happen in let's say, in Nigeria or South Africa?
Yes, I think in the days ahead, it's likely to have ripple effects across the borders. First of all, I think the developing countries are now facing a very difficult policy choices. The first policy issue they had to face is what they're going to do with the interest rate. Because when the US raised the interest rate so fast and so high, if the developing countries don't do anything, then they have to do something with their exchange rate because of the capital inflows issue. On the other hand, if they raise the interest rate themselves, they're likely to face the same problem that the US has. And that is, many of the banks in the global south will face the issue of liquidity and solvency because of the duration gap that Elliot mentioned, but also because the activities on the real side of the economy are likely to be reduced too because of the current global growth. Right now, what happened in 2023 is that there is a decline, a sharp decline in economic growth. And that's on the real side of the economy. That's going to affect the activities of the banks in developing countries while they're facing higher interest rate. Okay, so that's that create a lot of weaknesses in the balance sheets of the banks and of enterprises in developing countries. The other thing that it could that the transmission could take place is that and in fact, the most important thing that the current crisis will have on the developing countries is the debt crisis, the external debt crisis of developing countries. These countries was facing that even before the pandemic and even before the Silicon Valley Bank. What happened is that in the period between 2010 to 2017, okay, a lot of sub-Saharan African countries, including Zambia, for example, Ghana, these countries have borrowed a lot on the international market, in particular Euro bonds. So instead of borrowing from official lenders like the bank, like the World Bank, the IMF, for example, these countries switch over to private creditors who are usually actually they're just private and they wanted to make the most of lending. And these loans that they borrow, either through Eurobond or through the banking system, are affected by the interest rate increase. For example, up to 40% of the loans in low middle income country are actually based on variable interest rate. So when a loan is based on variable interest rate and the interest rate increase, of course, then you have to service the debt more. So you have to pay more for your debt. And that's going to create problems for countries from Zambia to Ghana. Worst time. Why? Because the two key things that affect the debt sustainability and the debt solvency of a countries are one, interest rate, and two, growth rate. In both cases, the current events lead to an increase in interest rate and a decrease in the growth rate. And both of these will work together and force many developing countries into more debt problems, more debt solvency and sustainability. And this is something that we need to be aware of.
Okay. Now, Heliette, in response to what Hin was describing as the current climate, what are some of the policy measures that you would advise can be taken in these kinds of economies with these current challenges to minimize the impact of what happened with SVP? Heliette,
me?
Okay, we can hear you now.
Hello?
Yes.
Yeah, okay, thank you. So I was saying that I absolutely agree with what Hin described and the bad timing of both interest rates going up, growth decreasing. And I would add, because it is my expertise and it is a reality as well, the price of commodities, raw materials, critical metals to develop solar panels and wind turbines and so forth. Some countries are blessed, hopefully, because sometimes it does not go so easily as a reasoning, but when they have commodities and commodity prices go up, this is certainly a good piece of news. In particular, when this is transferred to the population and not wasted somewhere in the pipelines or in the whatever. And but at the same time, so those which do not have any raw materials, if we take a country like Ethiopia, what they have essentially is a good agricultural system, but up to weather events, droughts, and so forth. So we understand that the situation is not exactly easy. SVB is not exactly the threat for them, but obviously the changes in interest rates, and as was just said, the fact that a large fraction of their bonds are variable rate bonds with a higher coupon payment when interest rates go up. So as a solution, I would absolutely mention that we have understood the benefits of bonds called commodity-linked bonds for precisely a country like Ghana, where investors may be interested in purchasing a bond where the coupon payment will go up together with the price of cocoa. We have now all these so-called ESG green bonds, and we should make sure that they are manufactured in a way that individual investors would be happy to buy them, to behave well, and that big structures like BlackRock would be also happy to buy them, because it would give to the global portfolio of BlackRock a greener image, a better ESG rating, meaning that we need to be creative. Emerging countries obviously face difficulties which are not the ones of developed countries, and we should be particularly careful in paying attention to their needs and making sure that developed countries try to behave in their direction in a way which is supportive. And indeed, they need to raise money, they need to issue bonds, and they are quite sensitive to interest rates in many manners. And we need to try to help them. And we need to give very favorable ratings to bonds issued by countries where the economic development is not too stable, and basically trying to help them. When they issue bonds to create solar panels, when they issue bonds to develop hydroelectricity of the river, preferably not to destroy the beautiful environment, developed countries and investors in these countries and big pension funds in these countries absolutely need to help them. And so it should be a cooperative game between the governments and the local financial institutions in these countries and the global system represented by the big developed countries whose names we know, and which they deserve to receive a large attention from them. It is it is crucial. That's my belief. I don't have spent as much time as in Africa, but I do, and including in my small charity projects, and I really think that we need to pay attention to this beautiful continent. And you know, it's like in difficult times you pay attention to your small banks, and in difficult times you pay attention to countries where the amount of raw materials is not very large, and which are very sensitive to whatever amount of money they will raise when they issue bonds of different types.
It's a very interesting recommendation, Juliette, on commodity-linked bonds. What other policy measures can be taken that you can describe to us?
I think the central banks in developing countries, in African countries, for example, would need to be very mindful of what is going on, and they need to make sure that their banks do have enough capital and liquidity requirement in order to guard against any risk. And to do that, they had to make sure that the bank assets classification is done correctly, and there's sufficient loan loss provisioning in the balance sheets of these banks. I think strengthening the regulatory framework for bank supervision is also very key. And just like the case of Silicon Valley Bank, the bank supervisors have to be quite awake, they have to pay very close attention to what's going on. Another thing that I didn't mention, and I think we didn't discuss, but it will have a very strong impact on what's going on, is that the problem of the non-financial institution. These are like insurance companies. These are like I forgot, the insurance is one, but also the funds, the various funds in the US and also in the global South. And the connection between this non-financial institution to the financial sector. There's a lot of exposure similar to the Silicon Valley Bank that's going on in this non-financial world that I'm talking about, and that hasn't been brought out yet, and it's likely to be coming up in the next few months in the US and also in developing countries. Unfortunately, there's not enough enough information in particular in Africa to say how much that would constitute a source of instability. But I think that remains one of the key sources. And in case if something happened to them, I think it's important that the central banks in these countries provide liquidity, but with guardrails, making sure that there will not be an issue of there will not be an issue of it's like I forgot the term, but there was a term on that to make sure that this problem will be isolated into the particular institutions rather than spreading it out. So these are the additional issues that I think we need to be aware of.
Thank you. We just have a couple of minutes left. I would like to give each one of you 1 minute in concluding thoughts and remarks, and perhaps any opportunities that you see that can come out of this crisis. Hin, will go to you, and we'll conclude with Heliet.
Okay, thank you. I think the problem that Silicon Valley Bank has brought to all of us is rooted in the events of the last 10 years. And the lessons that we should learn from that are, I guess, are four. The first lesson is that the risk management of any financial institution has to be constantly on guard. The second one is the regulatory framework has to be strong enough and has to be constantly revised over time to deal with the risk. Along the same line, the third lesson is that the supervisors of the bank have to be constantly on guard. And finally, the issue of monetary policy of the central bank. I think it needs to be taken into account the financial fragility of the country. And so it used to be said that the two are independent. Monetary policy and financial policy are independent, but nowadays you cannot keep that separate. So that's the four lessons that I think we learned from the banking crisis.
Thank you very much, Hin. Heliet, last word is yours. Heliet, you're muted. We can have the team perhaps unmute.
Yeah,
there we
okay.
go.
No. I did not want to make any noise while Hin was speaking. So I would say that indeed, SVB has been a warning to the financial system in the US worldwide. In particular, we see that regulators need to be creative. They need to be ahead of the new events, the new populations who are customers of banks, new risks like the one of having 100,000 depositors connected by their iPhone and warning each other to withdraw their money within a single day. This did not exist before, but there will be other types of risk of this nature which will emerge on the way, and regulators need to be prepared to follow all that, but to be ahead of the emergence of these new risks. So that's my first point. The second point is that going to emerging countries, we need, in particular, people like myself, to try to help them get their economies funded in a way which is going to be welcome by investors from all over the world in order to be robust to possible crises which would eventually come to them without any wrongdoing on their part, and that they would import from other countries, in particular developing countries, must be helped. The big countries cannot export their bad news only, and we need to think about being generous and being creative there as well. That's my final point.
Thank you so very much to both of you for an extremely insightful discussion. And thank you to the Policy Center for the New South and the team there for hosting a platform for this important conversation, and looking forward to many more to come.
Thank you. Thank you, Fatima. Thank you.
Yeah,